So we are starting chapter 9 this week. I'm going to try to get through this just really quick, just some information that you guys might need to know. Maybe I can help make it a little easier to understand. This chapter we're going to be moving out of like a normal general journal, and we're going to be working with special journals, which in my opinion makes things easier. We're just going to go through some stuff here, terminology quick, talking about merchandising. So a merchandising business would be like Ace Hardware, Hy-Vee, Fairway. And then they can be broken down a little bit further into wholesale or retail. So when we look at that, if we think about Hy-Vee, okay, Hy-Vee is retail. They sell directly to you, the customer. Somebody that is wholesale would be more like Land O'Lakes or Pepsi, where they sell their product to Hy-Vee and then Hy-Vee sells their product for them. So that's what a wholesaling business would be. So we're going to be looking at some new terms. We're going to be looking more at inventory stuff. So merchandise inventory would be the stock that a company buys and intends to resell. So again, let's use a Style Off for example. They get in a shipment of shoes. Okay, they purchase that. They're going to resell it after they've marked it up in order to make a profit. Okay, they also have to keep track of inventory. So there's two different ways to do that. There's periodic and perpetual. Okay, periodic means you actually physically go count your inventory X amount of times a year. Perpetual would be more like where a system takes care of what you, system like tracks what you sell. Menards uses more of a perpetual inventory system. So like their database, you'd log in and say, okay, we have 20 picnic tables in stock still. Okay, so the difference between periodic and perpetual. Okay, we're going to start working with, if we sell merchandise, we're going to use an account called our sales account. You guys obviously know what invoices are, so we're going to kind of buzz through this here. So again, there's different ways to record transactions. What we've been practicing through the whole textbook so far is we've been using a general journal. Okay, any transaction can go into a general journal. What we're going to start talking about now is our special journals. Okay, so anytime that you sell merchandise on account, you can use this journal called the sales journal. Okay, if somebody buys merchandise for cash, or yeah, then you cannot use it. It's got to be the sale on account only. Okay, we're going to look at what if somebody returns something. Okay, so if inventory is returned to you, we have to credit, and I don't mean debit or credit, but we have to give them an allowance for the product that they gave back. So we're going to use an account called sales returns and allowances, and you'll see what that looks like as we work through here. Okay, so a return, obviously the physical return of goods. The allowance is the reduction that we're going to give them, you know, based off of our return. Okay, a credit memo is just a written statement. We're not going to really work with those a whole lot. You'll see that come up in some of the activities. Okay, we're going to start talking about sales tax. So when you buy something, you pay for the item plus you pay sales tax. From the business standpoint, that business doesn't get to keep that sales tax. So when you're recording it, you have to record it differently in your journal. So you'll have an entry with the original amount of the purchase, and then you'll have to put in the amount of the sales tax just to keep those two things separate. Again, when we're doing a return, we have to return the sales tax as well. So that'll be factored in when you do your journal entries. All right, so I think for the time being, we're going to go ahead and stop with our slides, and we're going to go ahead and do a practice activity. So I'm going to stop this video, and then I will start a new one with one of our activities together.